I'm Noli Shaw. Welcome to our February 2025 Tax Roundup. Today, we'll be diving into the updated ATO guidance on property development, a topic that always sparks a lot of interest. But before we get into that, Michael will be walking us through the latest updates in the Bendel case. The federal court has handed down its long-awaited decisions in the Bendel case. Michael, can you explain to us why this is so important?
Yeah, the Bendel case is definitely the big news item in the world of tax for February 2025. And this is an issue that has really been around 15 years in the making. Let's just take a quick look back at how we got to where we are before we then have a look at the recent decision from the full federal court. What the Bendel case really looked at fundamentally was the tax treatment of an unpaid present entitlement, so an unpaid distribution owed from a trust to a corporate beneficiary. And the real issue was, do we treat those unpaid present entitlements as if they were loans for Division 7A purposes? Now, if we go back to early-ish 2009, the ATO's position on this was pretty clear. The ATO said publicly that a UPE owed from a trust to a company was not a loan for Division 7A purposes. Now, that didn't mean that Division 7A couldn't be triggered in other ways, but it didn't fall within the scope of the straight Division 7A loan rules. Well, that all changed in December 2009, just before we were all about to go on Christmas holidays, because the ATO released some draft guidance, basically changing the view, completely changing what the Commissioner had said previously and saying that the ATO had basically changed their mind and that they now thought that a UPE could be treated as a loan. Now, I'm not going to kind of get into the detail of the technicalities behind it, but in essence, what the ATO was saying was that if you look at the provisions in Division 7A, Section 109D, deals with loans and has an expansive definition of loan. So loan includes loans under the ordinary meaning of the term, but also includes some other things such as the provision of financial accommodation. The ATO was basically saying that if an unpaid present entitlement is owed to a company, the company knows it's entitled, and where we have related parties, that's kind of taken to be given, then effectively by not demanding payment of that unpaid entitlement, the company is providing a financial benefit, some financial accommodation to the trust. Therefore, it's a loan. Therefore, we have a Division 7A loan issue. So the ATO kind of stuck to that position. Even only a couple of years ago, the ATO refreshed its position with a couple of minor technical changes, but the essence still being the same, that the ATO's view was that a UPE was a loan for Division 7A purposes in most cases. Now, this issue had not really been tested properly until recently. First of all, we had an AAT decision in the Bendel case where the AAT held for the taxpayer who had argued that the UPEs owed from their trust to their company were not loans for Division 7A purposes. So we had an initial win at the AAT. The ATO appealed that decision, not unsurprisingly, and it went straight to the full federal court. And we've been waiting a while now for the full federal court's decision, which was finally handed down in February. And as you might know by now, the full federal court found for the taxpayer's position the ATO's appeal was unsuccessful. The full federal court decision in some ways is kind of relatively simple, really focusing in on what is the essence of a loan. And again, without going into all the kind of technical detail behind the argument and the reasoning for the decision, there's probably a key theme or a key principle that stands out from that decision. And that is, the full federal court said that even though an unpaid present entitlement might give rise to some sort of debtor-creditor relationship, that isn't enough for something to be treated as a loan. There's a fundamental difference between an obligation to pay an amount, which is what a UPE is, and an obligation to repay an amount, which is what a loan is. A UPE is an obligation to pay. A loan is an obligation to repay something. And there's a fundamental difference between those two things. That's probably the real basic essence of the full federal court decision. Now, the question is, what happens next? We've been inundated with questions already in terms of, well, what do we do? Do we kind of now go back and try and amend returns? How does this play out? Look, we don't know at this stage. And for the time being, it probably, where possible, pays to be just a little bit patient. There's a couple of things that could happen here. First of all, the ATO might appeal this decision to the High Court. There's no guarantee the ATO will actually hear that appeal. There's kind of two steps to that process. We're not sure whether that will happen or not. The fact that we have a unanimous decision by 3 full federal court judges suggests that maybe it's less likely that the High Court would kind of consider an appeal. But look, we really just have to wait and see. We'll hopefully know some more over the next few weeks in that space. Another possibility is that the government might step in and take action. Now, you might remember that a number of years ago, the government kind of made the announcement in a budget that Division 7A would be rewritten, and we had a Treasury consultation paper to kind of start to expand on some of the areas where Division 7A might be rejigged a little bit. And one of those areas was basically legislating to ensure that a UPE was treated as a loan for Division 7A purposes. Now, we've never really got anywhere on those reforms. Government's kind of gone pretty quiet on those in recent years. This might be the trigger to basically spur Treasury and the government into action to maybe put through some changes, possibly retrospectively. We don't really know. So again, we're just not quite sure at this stage where this will end up. Probably the third thing that we're just waiting for is also the ATO's kind of public response to the decision. When the AAT decision was handed down, there was an interim decision impact statement released by the ATO, basically saying that until the full federal court appeal was heard and handed down, that the ATO would continue to administer Division 7A in accordance with existing guidance. It remains to be seen what the ATO will do now. If there is an appeal, if there's not, we really need the ATO to come out and tell us what the plan is in terms of how Division 7A would be administered, not just going forward, but what about over the last 14 or 15 years? This is an uncomfortable spot, I would say, if you were kind of the commissioner at the moment. This puts a lot of things that have happened already in some doubt. And it's quite possible that taxpayers trying to do the right thing have actually hurt themselves from a tax point of view by following ATO guidance. And then that's not a great thing to have happened. And so it really is just a matter of waiting and seeing what the ATO says in terms of where we go to next. We'll definitely let you know as soon as we hear anything.
So, Mike, are there any other tax issues that we need to keep in mind when there are unpaid trust distributions owed to a corporate beneficiary?
Well, look, even if the ATO doesn't appeal the full federal court decision, or even if the ATO's appeal is not successful, and assuming the government doesn't step in and change the legislation, look, there are still some things we need to consider quite carefully when we are dealing with unpaid present entitlements owed from a trust to a corporate beneficiary. Now, before December 2009, the issue that we used to focus on a lot was the possible application of subdivision EA. And over the last 14 or 15 years, I wouldn't say we've forgotten about those provisions, but they've certainly become a lot less relevant and less applicable. But that assumes that the ATO's view was right, which we're now seeing maybe wasn't the case. But look, let me just kind of quickly summarise subdivision EA for you. Basically, what subdivision EA of Division 7A says is that where a trust appoints income or a trustee appoints income to a corporate beneficiary that's left unpaid, and then the trust provides certain financial benefits to shareholders of that company or associates of those shareholders, then that can fall within the scope of Division 7A. And so basically what we have is a position where even though the UPE owed to the company might not directly trigger Division 7A if it's not a loan, but it's the second step that can trigger the Division 7A problem. So the trust owes money to the company. Rather than giving that money to the company, the trust is providing those funds in one way or another to someone who's a shareholder of the company or their associate. So subdivision EA is really designed to address that. And look, if it turns out that the full federal court stands as is, it's not overturned and the government doesn't change the rules, subdivision EA is the thing that we're going to be needing to look out for very, very carefully. Something, as I said, a lot of us maybe haven't been paying as much attention to over the last little while because it hasn't been as relevant as it used to be. So that's definitely something we'll need to look out for. Subdivision EA, there are kind of also some further provisions which deal with situations where you have multiple chains of trust. So Trust A owes a UPE to Trust B, which owes a UPE to the company, and either of the trusts then provides benefits to shareholders of the company or their associates. So, yeah, there's a range of situations that might then be caught up by Division 7A. Outside of Division 7A, don't forget the ATO's guidelines over the last couple of years on Section 100A. 100A is the trust reimbursement agreement rules, basically where a trustee has appointed income to a beneficiary, but the benefit of those funds is enjoyed by someone else in connection with a reimbursement agreement. And a lot of us have spent a lot of time kind of poring over the ATO's ruling and guidelines in terms of how 100A might well apply, how the ATO interprets 100A, and some of the different scenarios and the risk level that sits with those scenarios. You'll see in some of the ATO guidelines references to unpaid present entitlements owed to corporate beneficiaries and what might need to be done to ensure that those are treated as low risk for 100A purposes. What that all means is that if the ATO isn't successful in appealing the Bendel decision and the government doesn't change the rules, then it may be that the ATO starts to focus even more on 100A when it comes to these unpaid entitlements owed to a company. Again, we'll just have to wait and see whether the ATO kind of shifts its approach a little bit. The third thing that we just need to be careful about is then Part 4A. Now, Part 4A is a bit tricky because it doesn't fall within, I guess, the self-assessment regime. It's up to the ATO to come and apply and make a determination to apply Part 4A. But we have seen some examples over the last few years where the ATO has started to use Part 4A in situations involving trust arrangements and in the way that distributions have been structured. Now, so far, those have been dealing with very specific cases. There's a possibility that the ATO might kind of expand out, I guess, its view on when Part 4A could apply. The ATO might say, well, look, we thought this specific integrity rule applied to these situations. Well, if it doesn't, we might look at what other tools we have in the armoury to basically attack these types of arrangements. And Part 4A is one of those tools. So again, we're not quite sure how that will play out, but something to keep in mind. There's a few things there that the ATO could still use when it comes to unpaid trust entitlements. Still an area to be very careful about, even if the Bendel decision ends up standing.
Thanks, Michael. Now, let's turn our attention to the ATO's updated website guidance on sales of land, including small-scale land subdivisions. Anne, could you take us through some of the examples that are included in these updates?
Thanks, Amy. So the ATO has added some new examples to the examples of tax consequences on sales of land, including small-scale land subdivision document, which can provide some helpful guidance where clients are subdividing and selling their properties. So the document now includes 7 examples that cover relatively common transactions, like property flipping, small-scale subdivisions, and property development. The ATO includes 2 contrasting examples on property flipping. So in example 3, someone repeatedly buys, renovates, and sells properties where she engages in market research, seeks professional advice, takes out business loans, and then carries out the renovations in a business-like manner. The ATO sees this as running a business, since her primary intention is to make a profit from the renovations and the reselling of the properties. When she acquired the property, her intention was clearly to make a profit through the property flipping from the beginning. So the profits here are treated as ordinary income on revenue account, and the CGT provisions don't really apply since the properties are treated as trading stock. But in contrast, in example 4, someone buys a property planning to live in it and renovates it. However, ends up selling it due to personal reasons, like losing her job and family illness. She undertakes the renovations herself with the help of tradespeople when needed. So here the ATO views the sale as a capital gains event and not ordinary income, because there's no commercial intent. And this can even be the case where there happens to be favourable market conditions when she is selling. There are also 2 contrasting examples that deal with subdividing land. So in example 5, someone subdivides and sells part of their main residence because of ill health and debt. His activities related to the subdivision are considered small scale and limited to the necessary activities for approval and subdivision. So since he didn't initially intend to profit from the subdivision and the sale of the vacant land, the ATO views the sale as a mere realisation of a capital asset rather than a business venture. But on the flip side, in example 6, this involves someone who actively manages the subdivision. She purchases an investment property with the explicit intention of subdividing the land and selling the separate lots for profit. So here she engages professionals and enters into a development agreement to oversee the subdivision and actively manages the project. So in this case, the ATO considers that there is clearly a profit-driven business-like activity. So the profits are treated as business income on revenue account and not capital gains. The various examples also touch on the GST implications in the different scenarios, which is another layer to keep in mind. The GST treatment is very likely to be consistent with the income tax treatment. That is, if the taxpayer is carrying out a profit-making undertaking, then they're also very likely to be subject to GST on the sales as well.
So, Anne, what are some of the key things that we should be taking away from this updated ATO guidance?
Thanks, Mike. So the examples clearly illustrate that land transactions can have a wide range of tax outcomes depending on the facts. The main thing to remember is that intent matters. So similar transactions can have very different tax outcomes based on factors like financial hardship, personal circumstances, or health. At a high level, to determine whether there is a profit-making scheme or the property is held on capital account, the ATO would review different things like the intention when the property was acquired and throughout development, the complexity of the process of subdivision, construction, and selling the property, whether the client has a history of property development, and the length of the time that the property was held. So the examples also show that it's important to get this right, as the tax outcomes when the properties are held on capital versus revenue account are very different, and we would expect that there's often large amounts involved. So if a client wants to argue that a sale is on capital account, then they need to have sufficient evidence and documentation to back that up. It's also worth noting that this is not the only source of guidance on this. So the ATO website has a number of web pages that cover the tax consequences of small-scale land subdivisions. And there's also the MT 2006-1 and the TR 92-3, which have detailed guidance on isolated property transactions.
And that's the roundup for this month. Changes are constant in the profession, and if you want to make sure your firm is operating at best practice, Knowledge Shop can help. We provide a technical help desk, work paper knowledge base, client newsletters, and regular CPD, just to name a few. If you want to take a look, then jump onto the Knowledge Shop website and book in a time for a tour. We'd love to show you what we offer to thousands of accountants across the country every single day. We look forward to speaking to you soon.